Is Europe's pursuit of energy independence leading it into a new economic challenge? As the European Union prepares to phase out Russian natural gas imports completely by 2027, concerns are growing across the continent. Critics argue that this decision, while politically symbolic, could bring serious economic consequences, especially for industries and workers already struggling with high energy prices. One of the sharpest warnings came from Petra Steger, a member of the European Parliament from Austria's Freedom Party. She believes that by cutting off affordable energy supplies too quickly, Europe may be putting its own stability at risk. So, is the EU's energy policy truly a path toward independence, or could it create deeper problems for Europe's economy and global competitiveness? Let's take a closer look at what's happening and what it could mean for the years ahead. On Monday, the EU Council officially approved a phased ban on Russian natural gas imports following a proposal from the European Commission. Under the new plan, purchases of Russian gas will gradually end starting January 1, 2026, with a transition period for existing contracts lasting until January 1, 2028. This decision, hailed by some as a major step toward energy independence, has also triggered significant criticism within Europe. Austrian MEP Petra Steger described the move as an economic self-destruction, arguing that such measures could push the European economy toward a new wave of industrial decline, higher unemployment, and loss of competitiveness on the global stage. According to her statement, it will be extremely difficult, if not impossible, to replace the lost gas volumes with alternatives at economically viable prices. She noted that liquefied natural gas, LNG, while politically appealing, remains far more expensive and presents major logistical and environmental challenges. Steger pointed out that Europe's industries are already under heavy strain due to rising energy kits, forcing many companies to relocate production outside the continent. She warned that another sharp increase in expenses, driven by what she called ideologically motivated energy decisions, could accelerate this trend and result in the loss of tens of thousands of jobs. The MEP also criticized the Austrian government for not vetoing the EU Council's decision, arguing that Vienna should have prioritized protecting national economic interests. Meanwhile, Russian officials have repeatedly stated that Western governments made a serious mistake by cutting off energy cooperation with Moscow, claiming that many European buyers continue to purchase Russian energy indirectly through intermediaries but at a higher price. Economists across Europe remain divided. Some argue that long-term diversification is necessary to protect the EU from geopolitical dependence. Others, however, warn that rapid policy shifts could destabilize markets and accelerate deindustrialization in countries heavily reliant on manufacturing, such as Germany, Austria, and Italy. The current energy debate goes far beyond short-term politics. It raises fundamental questions about Europe's future direction. Can the continent achieve energy independence without sacrificing economic growth? Or will it have to accept a period of slower production and higher costs as the price for autonomy? The EU's 2027 target remains ambitious, but it also reveals a growing divide between the political vision of Brussels and the practical concerns of national economies. If energy prices continue to rise and industries continue to move abroad, Europe may soon face a dilemma between climate goals, political ideals, and economic realities. The next few years will show whether Europe's strategy leads to a stronger and more resilient union or a deeper economic slowdown that challenges its unity from within.